Welcome back to our class. In our last video, we have discussed the valuation techniques using mergers and acquisitions. In this video, we will introduce anti-takeover strategies. If the management and the board of a target company do not accept the terms of an acquirer, anti-takeover measures can be imposed to drive off potential hostile bidders. There are three categories of preventative strategies that can be imposed in advance to fend off a bidder: shareholder right plans, corporate charter amendments, and golden parachutes. The first anti-takeover strategy we will discuss is shareholder right plans, which is also known as poison pills. In shareholder right plans defense, certain rights are distributed to shareholders in the form of a dividend, the poison pill, and the rights can be activated after a triggering event. The shareholder right dividend is not a cash dividend, but typically takes the form of an option, a warrant, or preferred shares that comes with a right. A shareholder right plan can be authorized by the board of directors without shareholder approval. A poison pill significantly increases the cost of an acquisition. Let me first introduce two types of poison pills: flipping poison pills and flip-out poison pills. These poison pills can be triggered upon hostile takeover events, say an acquirer gaining 30% of a company shares. A flipping poison pill gives existing shareholders, except the hostile bidders, a right to purchase additional shares of the target company at substantial discount. The newly issued shares will dilute the ownership of a hostile bidder and increase the cost of acquisition. In a flip-out plan, shareholders of the target company have the right to buy the acquiring company's shares at a discount after acquisition. A flip-out plan dilutes the shares of the acquiring company after acquisition and may drive away an acquirer. The use of poison pills faces criticism that it entrenches inefficient management. For example, in year 2008, Microsoft paid $31 per share for Yahoo, which was a 61% premium to its market price. But the management of Yahoo rejected Microsoft. Later, Microsoft raised the offer to $33 per share, which was considered too expensive by many market observers. But Yahoo still rejected. Yahoo had a poison pill on hand, and CEO of Yahoo, Jerry Yang, threatened to do everything in their power to make the acquisition difficult. Later, Microsoft stepped back. Share price of Yahoo dropped after Microsoft went away, and this failed deal was followed by investor lawsuits to Yahoo management. Other forms of shareholder right plans include back-end plans and voting plans. In a back-end plan, shareholders receive a right dividend, which gives them the ability to exchange their shares to cash or debt securities of the company at a specific back-end price that is above the market price. A back-end plan can be triggered if a bidder acquired a significant amount of shares. This establishes a minimum price for a takeover. In a voting plan, companies issue a dividend of preferred stocks to shareholders. Holders of preferred stock become entitled to super voting rights when an outside entity acquires a substantial percentage of the company. This plan dilutes the voting power of a hostile bidder. Poison pills can be imposed or cancelled by company board. In order to prevent a hostile bidder from gaining control of the board, such as through proxy fights, corporate charters can be amended in advance to make it more difficult to replace the board. Corporate charter amendments typically require shareholder approval, but in cases of very poor management, shareholders may vote against anti-takeover amendments. Common strategies include staggered board, supermajority provision, and dual capitalization. Staggered board means that only a few, such as 1/3 of the directors, may be elected during any given year. Staggered board is also called classified board. Staggered board defense can be imposed by revising corporate charter. The staggered board may prevent an acquirer from gaining control of the board in the short run and remove poison pills. A supermajority provision means a higher than majority vote, typically 80% of 2/3 approval, are required to approve a merger. This provision is effective if a hostile acquirer cannot reach the supermajority threshold. For example, if a supermajority vote of 80% is imposed to approve a merger, and the parties friendly to the management have 25% of all outstanding stocks. A hostile acquirer can find it difficult to complete the acquisition if the other 25% do not approve. The next strategy is dual capitalization. Dual capitalization is a restructuring of equity into two classes of stock with different voting rights. One class is common stock with 1 vote per share. The other class is stocks with super voting rights. For example, say 10 votes per share, or even 100 votes per share. The super voting stocks are usually distributed to all shareholders, but can be exchanged for common stocks. Because the super voting stocks usually pay low dividend and lack liquidity, most investors not interested in corporate control would choose to exchange the super voting stocks for common stocks. Super voting shares tend to accumulate in the hands of management and their alliances. In the market of corporate control, there is a type of hostile investors called corporate raiders. They would first acquire a substantial amount of shares and then threaten to initiate a bid for control unless paid. Corporate management may choose to pay the raiders by repurchasing their shares at a premium to market price. This payment is called a greenmail. In nature, it is the targeted share repurchase above market price. To fend off potential corporate raiders, a company can add anti-greenmail provisions to its company charters. An anti-greenmail provision restricts the ability of management to pay greenmails to corporate raiders. Another type of preventative strategy is the golden parachute. Golden parachutes are special compensation agreements that the company provides to upper management on termination of their employment. Golden parachutes may substantially increase the cost of smaller acquisitions, but for large deals, the cost may only account for a little fraction of the deal size. So the effectiveness of golden parachutes on corporate defense can be controversial. In addition to the many preventative strategies that a company can launch beforehand, a company facing a hostile bid can also use a series of active defense strategies, including white light, white square, Pac-Man defense, crown jewel, and litigation. First, let us look at white knight. In corporate defense, a white knight is another company that offers to buy all or part of the target company. A white knight usually offers more favorable terms than those of the original bidder, such as a higher price. A white knight is also usually friendly to the current management, and they promise not to replace the management or lay off employees. The white squire defense is similar to white knight defense in that a white squire is also a block buyer friendly to the current management. The difference is that a white squire is not interested in acquiring control of the target. For example, in year 2016, Baoning Group started a series of hostile bids against Vanke. Vanke later introduced the Shenzhen Metro Group as a white squire to fend off Baoling. Today, Shenzhen Metro still owes 29% of Vanke. Introducing a white squire is appealing because a substantial amount of the stock of the target will not be sold out to a hostile bidder. If supermajority vote provision is required to approve a merger, a white squire defense can be very meaningful. Another active defense is Pac-Man defense, which is named after the famous video game Pac-Man. In Pac-Man defense, a target responds to a hostile defense by making an offer to buy the raider instead. For example, in the U.S. oil industry, Mesa Petroleum launched a hostile takeover against City Service Oil Company in 1982. Mesa Petroleum was much smaller in size. City Service responded with a bid for the smaller Mesa Petroleum instead. Next, a target can sell assets an acquirer wanted the most to a third party in event of change of control. The core asset is often referred to as the crown jewel. This defense makes the target unattractive to a hostile acquirer. Last but not least, a target company can always try to bring a hostile bidder to court if the bidder had potential illegal conduct. For example, the target can sue a bidder if the bidder does not provide adequate information on how to finance the acquisition. For example, to defend itself from the hostile bidder Baoling Group, Vanke reported several misconduct of Baoling to government authorities, including potential illegal use of insurance funds to fund the acquisition. In addition, a target may also take advantage of antitrust laws to fend off a bidder. Okay, in this video, we have discussed preventative and active defense strategies a target company can use against hostile bidders. Thanks for watching. Next week, we will have another chapter on leverage buyouts.